Hello and welcome to the latest Insider interview. Our guest today is Luke Finch of Hg Capital, which manages the Hg Capital Investment Trust. Luke, thank you very much for coming into the studio.
Thanks for having me again, Sam.
HGT invests in software businesses, but what is the outlook for the sector? What are the risks and what are the opportunities today?
So look, we just see huge tailwinds, which we just spoke about in terms of demographics, regulation. Inflation actually is another one. You know, when inflation is is high, expensive things get more expensive faster. So your expensive workers get more expensive, and you can't keep hiring more people to do in your finance team, for example, to help you with your accounts, and you need to use more software. And then obviously you've got AI now as a sort of huge shift in the software market, which we think is incredibly exciting. So every 10 or so years you have these kind of innovation waves rolling through software, going from mainframe to PC to kind of server, and then up into the cloud, in the SaaS business model, which is still playing through now. And then on top of that, you've now got AI, and each of these waves builds on the last. So we think that's an incredibly exciting time for us.
And how are your portfolio companies using AI to improve their businesses?
So we think about it in sort of two ways. One, there's the cost side. So how are you improving your own processes using AI? And software companies are themselves pretty tech savvy, so they're probably at the forefront of using a lot of these new tools. So one of the biggest expense lines in our software companies over the years has been developing engineering talent. And what we're seeing with some of the tools, like kind of obviously GitHub and GitHub Copilot, but now Devin and other sort of agentic tools that we're rolling out across the portfolio, is huge kind of productivity gains across our engineering workforce. So that doesn't mean we're letting go engineers, it means we're doing more with the same number of engineers. So kind of product innovation is happening faster. Then on things like customer support, again, we're seeing sort of agentic tooling come in, and we've got specific, because of our size, we've got 50 plus portfolio companies, 150 billion of total EV. We are a big software company. If you look at it that way, we can do special kind of agreements and deals with some of these new providers that we can roll out across the whole portfolio. So we're seeing kind of big productivity gains in customer support. So that's on the cost side of our businesses. And then on the product side, it's sort of how do we take these LLMs and the new tooling available and overlay that and offer up new product to our customers. And I think what's really interesting for us is, software for the last 40 years has been deterministic. It's you put some rules, you put some data through it and some rules through it, and out comes an answer that's kind of right or wrong. LLMs are probabilistic software, so that's a whole new thing that software can do. It can kind of create stuff based on the sum total of human language and what's probably going to be right. And that's super interesting, because what it allows our companies to do is look at all the workflows that kind of surround the core thing we're already doing. So we're already helping you file your taxes. Well, what's all the messy data aggregation, human touch points, customer touch points that feed into that, and can software do more of that? And so for us, we think that the LLM, that this new era allows our companies to think about, well, what else can we do for our customers? How else can we save them time and money and get more efficient?
And on the other side, what is the bear case for software? What are you worried about as software investors? Is AI a disruptor as well as an opportunity, perhaps?
No, it's definitely a potential disruptor. And I think if our companies stuck their head in the sand and said, well, this isn't going to impact us, then that will be a problem in the next few years. Just like the last disrupting wave, which was kind of SaaS and moving to the cloud, old on-prem software businesses that stuck their head in the ground and didn't think about that, they got badly disrupted. It takes time though, because you've got customers that need your service. And I guess the way we think about it in part is the opportunity is what's all the other messy workflows that we can do. Well, if someone else goes and sort of does those messy workflows first, then can they come back into your core workflow in time? So for us, the opportunity of pushing out and seeing what else we can do the flip side of that is a threat that people who do that better might eventually come into your core market. I think the good news is as the incumbent with the customers and with the data sets that matter and the trust to manage those workflows already, we feel our portfolio is in a really good place. And one thing we're asking all of our portfolio companies to do is really over the next, by the end of this year really, have 5 to 10 AI first products in market with their customers. That's what we've told our whole portfolio to do, and we're working with them to help them do that. And again, our size and our expertise and the ability to say to one portfolio company, well, look what's working really well here, why don't you try that, and let's fast track that learning. I think that gives us a really good opportunity to help our businesses bring AI product to their customers.
Digging into the portfolio, can we get some colour on the revenue and earnings growth of the businesses that you invest in?
Yeah, so I think we've got a very strongly growing kind of high margin portfolio. So I can only talk historic numbers for you, I'm afraid, but the LTM numbers for the top 20 portfolio companies at March were about 20% revenue growth and just over 20% EBITDA growth. About just over half of that revenue growth was organic, and the margins were 33%, I think, roughly across that top 20. So in software you often talk rule of 40 being the sort of benchmark, which is you add your organic growth and your margin. And if that's north of 40, then you've got a very good business. You can either have a very high growth business at zero margin, or you can have a 0% growth business at 40 margin. We've got roughly 12% and 12% organic growth, 33% margin, so kind of decent rule of score. And that's pretty consistent across the portfolio.
This is a private equity trust. So how is the private equity industry today? Are there lots of companies coming to market and listing their shares, or is it a bit slower than it might have been in the past?
So I can't talk about the whole private equity industry because obviously we're pretty focused on what we do. So we don't do retail and we don't do consumer and we don't do large parts of the economy we don't look at. Our bit of the market is robust, is functioning well. Like I said, we've had lots of exits over the last 2.5 years since we met, and we've succeeded on everything we brought to market for liquidity. And we're getting outbid on things that we like on the buy side. So it's a robust environment. I think private equity is a bottom-up industry. You can't really generalise. Some managers are doing well, some are doing poorly, and I think in private equity, knowing what you're about and being deliberate on that is what's going to set you apart.
Vizma is one of your largest positions. I saw rumours that it might list its shares in London. Are you able to comment on this?
I can't say too much about sort of potential listing for regulatory reasons. So no comment on the listing piece. But look, Vizma's been a part of the portfolio for HGT for a long time. It's coming up to 20 years that we've been invested in it. It's gone from being about 400 million enterprise value when we delisted it back in 2006 to the last valuation round when people invested in alongside us was just about 20 billion euros. So it's a real success story for us and for the industry as a whole. And I think and I hope that it shows that PE is not a short, doesn't have to be a short-termist, view. So if and when we do list Vizma, we'd hope it sort of looks a bit different to kind of other kind of private equity IPOs over recent years. And I think it's a very high quality business. It publishes its accounts quarterly, publicly, so everyone can see what that looks like. And I think the investor community is sort of very excited about a chance to potentially invest in that.
And could you just explain what Vizma does? I think it's a 16% position in the portfolio.
Yeah, so Vizma, I guess, sort of started off in Norway doing sort of SMB, so small business bookkeeping. And what it's done over the years is it's expanded out of Norway across the Nordics and then into Benelux and now into Eastern Europe and also into LATAM. So it's sort of the king of small markets in terms of offering that kind of SMB bookkeeping. It's also expanded its product set, so it sort of does bookkeeping, invoicing, payroll, sort of other things that small businesses need. So it's both expanded kind of its footprint to be multi-local, and its product offering to sort of really satisfy sort of a lot of the mid-office and back office of small businesses. And in the US, you've got a very large business like Intuit, which kind of has the QuickBooks product set. In the UK, you might have kind of Sage or Xero for some small businesses, and sort of really everywhere else, you've got Vizma.
And is it typical that the companies you own are kind of operating behind the scenes, and actually retail might not be aware of them?
Yeah, I think that's probably one of our challenges. Is we might be the biggest private equity firm that no one's ever heard of, because none of our businesses really touch the sort of consumer imagination or the consumer consciousness. Yes, if you own a bakery in Denmark, you've heard of Vizma. Or maybe if you're a cycling fan, you might have heard of Visma. It's probably the only one. Iris, which is another big company in the portfolio, files a lot of UK kind of accounts. Lots of accounting firms in the UK will use it, but sort of kind of who knows that? Not unless you're an accountant in the UK, you probably haven't heard of it. And almost all of our businesses have that flavour. Specialists doing a task in an industry will know that business. They'll know it because they use it for many hours a day, but their wives and children don't know it, or their husbands and children don't know it.
And finally, the question we ask all of our guests: do you personally invest in the trust?
I do. So, obviously, as a partner at HG, I have to and want to put a lot of money into our funds themselves. So we call that the kind of general partner commit, and I do that because I don't pay fees and carry on that. So most of my money goes in that way. But obviously, the beauty of the trust is I can put it in sort of tax wrappers, so SIP and ISAs and things like that. And my kids, well, they're probably too young to understand it, but I'm actually sort of trying the experiment with them on the sort of ISA long-term return. So I'm putting their JISAs into it. So we'll see where they end up after 18 years of compounding.
Luke, thanks very much for coming into the studio.
Pleasure. Thanks for having me.
And that's all we've got time for today. You can check out more insider interviews on our YouTube channel, where you can like, comment, and subscribe. See you next time.